We got more housing data points out this morning, just ahead of the key spring season. Diana Olick has the latest numbers. What can you tell us, Diana?
Well, Kelly, it's a lot, and none of it is good, I'm sorry to say. Let's start with single-family housing starts. They dropped 8.4% in January from December, and we're down nearly 2% year over year. That was along expectations, but still not a good sign, given that the market just needs more homes. The builders have been plagued by higher mortgage rates. The average on the 30-year fixed started January right around 7%, according to Mortgage News Daily, but then just started rising, hitting 7.26% 2 weeks later, and staying above 7% for the month. Builders like Toll and Pulte pointed to affordability issues in their latest earnings releases. Toll with a big miss on its top and bottom lines. Single-family building permits, which are an indicator of future construction, they were flat month to month and down over 3% year over year. We know builders are increasingly concerned about potential tariffs hitting their costs for everything from lumber to wallboard to appliances. Sentiment among the builders in February dropped sharply to a 5-month low, with the NAHB chairman saying high construction costs, elevated mortgage rates, and challenging housing affordability conditions are causing builders to approach this market with caution. And on top of that, mortgage demand from home buyers, it dropped again last week, down 6% for the week. Still a little bit higher than it was a year ago, but the numbers overall are just historically low, which is not where they should be right now, Kelly.
That's a great point. A lot of, like we've talked about, a lot of inventory on the market. The hot stuff is still selling, but the other stuff not so much. Diana, stay right there, because a proposal that started bubbling up in the first Trump administration, could have a big impact on mortgage demand and housing more broadly. And it's the privatization of Fannie and Freddie, picking up some traction after a CBO letter said back in December they see an easier path to privatization now than in the last report back in 2020. If that were to happen, Moody's Mark Zandi thinks it could raise mortgage rates by 60 to 90 basis points. My next guest says it could also trickle down into the Muni market. Let's bring in Wells Fargo head of Muni strategy, Vikram Rai. Vikram, can you kind of broadly explain this? Welcome.
Thank you, Kelly, and it's my pleasure to be here. So, see, whenever we talk about this issue, and this issue has been on the back burner and the front burner for more than a decade.
It's exhausting.
It's exhausting, yes. And it's a very complicated issue. So before we put the cart before the house and start getting stressed out about the privatization of Fannie and Freddie, there are some prerequisites that need to be met, right?
Really?
First and foremost, right, that when Fannie and Freddie were bailed out by the U.S. government, the Treasury took a senior preferred stake, right? So that's
and they're getting all that cash right now, right?
They're getting it in the form of dividends. So the senior preferred stake has grown to $350 billion.
Wow.
Right? And so that is something which is sitting on the Treasury's balance sheet, and that needs to be voided, meaning, that's taxpayers' money.
Right, so you think at a time when we have no money, we're going to say, here, take $350 billion off.
So politically, it's very unpalatable. Then, of course, there is this question about the guarantee, right? And that guarantee, it's not an explicit guarantee, as you know. It's the implicit guarantee, and it stems from the fact that in 2008, 2009, the Treasury granted them a line of credit, which they have kept increasing, so now it's virtually unlimited.
Yeah.
So that's the implied backstop, right? The implied guarantee. Now,
which keeps mortgage rates, maybe lower than they otherwise would. I don't know. This is a big debate in the markets, right? There's people who say that this whole system is all screwed up and the incentives are all strange and what have you, and we should just privatize it and let the private sector rush in, and I don't know, maybe somehow that brings down mortgage rates.
Kelly, I could not disagree with that more. Okay? See, housing affordability is at a multi-decade low, right? Rates are still high. So any disruption to the market, the TBA market, which is functioning very well, will have not just a trickle-down effect, it'll have a knock-on effect.
Is it having one? So when these discussions resurface, do you think that's having an effect on the mortgage rate? Because you know that the president and his Treasury Secretary are trying to come up with other ways to get mortgage rates down. And it sounds like any chatter around privatizing Fannie and Freddie then is not that helpful.
It's not helpful at all. And my clients call me all the time when this chatter came about. They were not freaking out, but they are worried about the market, that what impact it'll have, because it'll have a downstream impact on the Muni housing market too. So you know what HFAs are, that these are housing financing agencies, and their charter, their mandate is copacetic with the GSEs, meaning they're there
These are the state agencies, right?
Correct, the state agencies, they're local agencies too. And it's not a small market. It's at least 300 billion. Now, they increased, so the mandate is to increase affordability for GSEs. It's very similar for HFAs. They just do it for lower income borrowers.
I see, kind of like the FHA on a national.
Correct. Yeah. I mean, there are similarities, but they help with down payment assistance, they help with closing cost assistance, and they have access to a tax-exempt market. And the HFAs have done a phenomenal job in managing their credit portfolio and also increasing housing affordability.
Interesting. And they could be adversely affected? Oh,
they will be adversely affected because, see now, there is the whole DOGE initiative, right? It's controversial, but it's a noble objective that we want to save the federal government money, right? We want to save taxpayers money. Now the Muni market is it helps because the Muni market builds schools, bridges, tunnels, roads, etc. And so it spends money so that the federal government does not have to spend money, right? So now their balance sheet, the HFA balance sheet, they have to manage their credit very carefully. So the HFA balance sheet consists of loans that they've given out, and they have to monitor the quality of the loans very carefully because in a deteriorating macro situation, that there are loan delinquencies.
Yeah.
So what they do is that most of these loans are conforming loans, and so when they have to cleanse their balance sheet so that they can issue more loans, they sell them in the TBA market. Right, and or they're wrapped by Fannie and Freddie.
Yeah.
Now, if there is any impact to the guarantee, right? There's any impact to the guarantee, then there'll be collateral degradation of the balance sheet, meaning that the agencies, the HFAs, will get downgraded.
Yeah.
If the HFAs get downgraded, that means their cost of financing goes up. If the cost of financing goes up, that means the home buyers, they'll be impacted directly. Their costs will go up. And think about it, that rates are high, housing affordability is low, so why would they want to let that happen?
Understood.
And here I'm optimistic because this administration is very savvy. Right? When have we had a Treasury Secretary who comes and says that we're looking at the 10-year Treasury rate?
Exactly.
And that suits the market, right? When the Fed cut rates went up by 100 basis points. When Scott Bessent came on and said that we're looking at the market, we're looking at the 10-year rate, that suit the market, we rallied.
And they understand what this would do.
Exactly.
Diana, give us a final word here.
Well, I would just say that, I talked to Mark Calabria about this just last month in an interview, and he was the one who, in the first Trump administration, was tasked with trying to decide how they would take Fannie and Freddie out of conservatorship. He was the FHFA director, and he said he went with then Treasury Secretary Mnuchin to the Hill looking for a government backstop, and Congress said absolutely not. Now, you could say some are arguing you don't need a government backstop, and in fact, Calabria said that, well, the government bailed out Silicon Valley Bank, and it would just be the same thing if Fannie and Freddie got into trouble again, just like they did during the pandemic. They were there to help. But that's not going to happen in the broader market of investors. If investors are the ones who are supposed to come in and buy these mortgages from a private Fannie and Freddie with no backstop, they're simply not going to buy them. Mortgage rates are going to go way up. And as you just said, this is not a market that can handle any more hits to affordability. It is already one of the priciest housing markets in history. And as the numbers I just gave you, it's showing that it's the spring market and we're not seeing any demand out there because of this affordability issue.
Yeah. Hope springs eternal, I know, for investors who are looking for that privatization. But after this conversation, I'm thinking it's probably going to be another administration off. Vikram, thanks. Vikram Rai with Wells Fargo. Diana, thank you always as well, our own Diana Olick. If you want to know more on this story on Fannie and Freddie, check out Diana's deep dive on CNBC's YouTube channel. And coming up, another major firm doing layoffs. This time it's United Health offering employees in its benefits unit buyouts if they quit by March 3rd. Sources tell CNBC if the company does not meet its resignation quota, they will begin layoffs. Shares are down nearly 13% over the past 6 months and are fractionally higher today. Stay with us.
Muni Money is sponsored by BAM. Help build America's future with BAM-insured Muni bonds.
Infrastructure makes our economy grow and keeps our communities strong. And now's the time to build. BAM Mutual protects municipal bond investments that finance essential projects, providing an added layer of security to improve your portfolio with guaranteed income that helps investors reach their goals. Invest with confidence. Build a better portfolio with BAM insured bonds.